Hello, and welcome to the monthly roundup from Kepler Trust Intelligence. My colleague Ryan and I will be taking a whistle stop tour of all the news and reviews in the investment trust world over the month of August. Mixing up our usual schedule, we're going to start proceedings today with some news of a trust launch. We're joined by Thomas McMahon, our head of investment companies research, and he's going to talk us through the launch of Aberforth Geared Value and Income, also known as AGVI. Thomas, many thanks for joining us today.
Hi, Joe.
Could you start off by telling us a bit about the background of AGVI?
Sure. So Aberforth is a specialist manager of UK small caps. That's all they do. And they have a very distinctive strategy, which is a value focused investment strategy. Aberforth is a partnership and it dates back to 1990. All the funds have the same basic value strategy. And this basically sees the managers look for companies that are cheap and also preferably in a cyclical earnings downturn. They'll typically sell out to these companies as they approach fair valuations, and they'll engage with management and boards along the way to unlock value if they can. And then they'll often buy back into the same companies when the cycle turns. So they've seen the whole market, they've seen the same management teams time and time again over the years. Now, since 1991, Aberforth has had a split capital trust as a part of its range. And Aberforth Geared Value and Income is the fourth iteration of this split capital structure. So this structure consists of ordinary shares and what are called zero dividend preference shares. These are technically and officially their equity, but in all practical senses, they function as debt. So they don't receive a dividend, but the investors in the ZDPs receive a fixed capital entitlement of 160.58p when the trust reaches its planned winding up date in July 2031. So it has a 7-year fixed life. Now, you may be able to do that in your head, but if not, I can tell you that implies an effective yield of 7% annualized. So that's the effective cost of debt, but it's not received in interest payments during the life of the trust. It's all received at the end in one capital payment. So as the ZDPs don't receive dividends, all the income that is received by the investment trust can be paid out in dividends for ordinary shareholders. So they receive a much higher yield than they would do otherwise. And these ZDPs also mean that ordinary shares are effectively very highly geared, which is the critical point. So at launch, that was roughly 38% gearing. So this obviously means the growth potential in the shares is higher too, as well as potential losses in falling markets.
And what benefits does the capital structure have for shareholders, would you say?
Well, the first one is the yield that I just mentioned. Small caps don't typically pay a very high yield, but AGVI can boost its natural income effectively by about 38%, so give or take 40%. So it can pay a pretty handsome income without having to invest in what you might call value traps or deeply discounted shares, which are paying a higher yield because there's something wrong with them. It also means that the capital return potential is much higher. I think this is particularly interesting given the UK market as a whole is pretty cheap right now. It's been at a favour for quite some time. And so if we do get a meaningful recovery over the next few years, then this structure offers very high return potential. On the other hand, gearing works both ways. And so funds NAV, the value for ordinary shareholders will fall much more if markets do. And then, of course, as the 7-year fixed life draws near, it will become much more important to track how well the trust is doing versus that fixed capital entitlement of the ZDPs. So basically what happens is at the winding up date, the ZDP holders receive their fixed capital entitlement first, in the same way that debt holders have the first call on the assets of a company or a fund. So if there isn't enough money to pay back the ZDP holders, then ordinary shareholders have nothing. That's very unlikely, but it's always possible. And similarly, if there's only enough to pay back the ZDP shareholders, then they get all of it. So, returns would have to be pretty terrible for these scenarios to come into play, but nonetheless, it's something that has to be borne in mind as time goes on and as we get nearer to maturity.
So coming back to returns for a moment, what returns could shareholders expect from the trust?
Well, the first thing to be said is that shareholders should expect volatility. This goes hand in hand with gearing, and the discount should also be volatile too. We've observed that, generally speaking, highly geared trusts tend to see their discounts widen more in difficult markets as investors look to protect themselves from the effects of the debt in their portfolios. Similarly, if the market is very strong, investors might rush to try and take advantage of this geared portfolio. So you can see the volatility in the discount as well as the NAV. The prospectus suggests that in the first year, there should be a dividend of 4 to 5p. Now, with the current discount, that means that you're looking at a prospective yield of 4.6 to 5.8%, depending on where it falls in that range, which of course is a guide and not to be relied upon. And the reason for that is, as I said, the shares have fallen onto a similar discount to the rest of the sector. The small cap companies are on a roughly low double-digit discounts. AGVI is a little bit more geared, so it makes sense. It's on around a 13% discount as of the time we're discussing this. Now, when we turn to the longer run, the gearing means the range of potential outcomes is very wide. If you consider the discount, the debt, and the potential for dividend growth, then you can get some really very high returns if the markets are strong over a 7-year period. But equally, of course, you always have to be mindful of the potential for the gearing to go against you. So the range of potential outcomes is broad, and while this offers a really interesting way to add a high yield to your portfolio and offer some very high growth potential, for income investors who are looking for kind of a steady, quiet life, this is something they need to sort of bear in mind.
And thanks to Thomas for taking us through that. And now moving back to some other news, late August saw a bit of a boardroom battle at PRS REIT. So Ryan, could you take us through what's been happening?
Yes, of course. So the month finished with quite an interesting situation developing at PRS. For a bit of background, PRS is a real estate investment trust that specializes in residential houses. They look to buy large numbers of houses kind of off plan from developers and then rent them out, often to young professionals or growing families. I believe their largest tenant base works for the NHS, for example, so well employed groups. The trust, along with much of the sector, has been trading at a discount for a couple of years because of higher interest rates that have weighed on the sector and the prospects. Despite this, though, the board renewed the contract of the investment manager earlier this year without much in the way of consultation with shareholders or any consideration of other options. Now, this has led to a number of shareholders who have sort of come together and are trying to force some change as they're unhappy with the renewal agreement, especially in the light of the persistent discount.
Right.
We think this is interesting because there are kind of two arguments at play here. In the defense of the board and the investment manager, the factor behind this discount widening is staying wide has been the fact that NAV has gone up. This is a function of the assets it invests in. They are houses that have sometimes been going through construction. So as construction has been completed, the NAV has been written up because obviously the house is worth more, it's ready. As such, the NAV's gone up, but the share price hasn't quite followed that. Therefore, the discount has widened. And finding new shareholders to buy into this asset class is quite difficult at the moment. However, in the defense of the shareholders, residential housing is a fairly well understood asset class. People have very clear price discovery on it. Most people on the street will know what the value of a house is. So if you're offered the opportunity to get this at sort of a 20, 30% discount, people would very much take it. So these assets could equally be sold very close to NAV if you were to wind up the trust, for example, although the shareholders who are currently talking to the board about this say that it's not their intention. So there's really no clear reason behind the discount other than simply it's a lack of interest in the trust. Now, like we said, it's admittedly quite difficult in a high interest rate environment to increase demand for investment in residential property, especially amongst retail investors who is usually their biggest store of wealth anyway. So then trying to persuade them to invest in another portfolio of residential housing, quite difficult to do. However, the board's decision to renew the investment manager's contract during this period does raise some questions, especially around corporate governance and that supposed separation. There have been some really interesting claims and counterclaims by both parties. The situation is still ongoing and we expect it to develop through the month and beyond. But it's an interesting dynamic nonetheless. What this does demonstrate, though, is some of the benefits of investment trusts because shareholders can enact this sort of change. Unlike some other investment vehicles where investors are simply passengers along for the ride, investment trusts have that level of shareholder engagement. They have boards, they have management teams, so they're able to vote and instigate changes. So while these episodes often highlight challenging situations in the industry, it does at least show where there is an avenue for investors to express their views.
Thank you. Some very interesting developments. And moving on, the other piece of news you wanted to highlight was TRIG's buyback. So, what's of interest for investors here?
Yes, that's right. So August saw an announcement from the Renewables Infrastructure Group, aka TRIG, who announced a £50 million share buyback program. Now, against the scale of a trust that sits around 3 billion in assets, this isn't an enormous amount, but it does at least bring TRIG in line with many other trusts in the peer group where share buybacks have been rolled out as a tool in the past to help narrow the trust discounts, which have widened as interest rates have gone up. Now, TRIG's buyback is in part being funded through some disposals. The trust recently announced the sale of one of its offshore wind farms, a small section of that. The value of the sale was above the carrying value in the NAV as well. So it's also a good demonstration that the values in their NAVs could be quite accurate. These have come under question following the higher interest rate environment, with people thinking that these assets should be marked down. So the fact they've sold it at a value higher than it was in the NAV shows that that NAV is probably quite accurate. Now, this is one of a number of disposals that TRIG has made in the last few months. The proceeds have primarily been used to pay down short-term debt, which has been an issue for a number of trusts as interest rates have gone up. But the fact that TRIG is now using some of this capital, not just for paying down debt, but also for share buybacks, could be seen as an indication that they're much more comfortable with their debt position now, which is certainly more positive for shareholders and potentially shows that those headwinds against the trust could be reversing. This seems to have had an early impact on the shares as well. The discount has come in from around the high teens, low 20s area to below 15% at the time of recording, meaning the shares are up around 10% in the last 3 months. So it's certainly a good start, but if rates do continue to narrow, there could well be more to come from TRIG. There have been some other examples in the renewable infrastructure sector as well. Octopus Renewable, or ORIT, for example, they announced something similar in July. They sold a wind farm as well to pay down some of their expensive debt. ORIT is also going through a share buyback program as well, albeit at a slightly lower absolute amount than TRIG. Potentially because of this, the discount is still a little wider than TRIG, although both trusts are still paying very decent yields of over 7%.
So, all things considered, plenty still to happen as these situations continue to develop.
Absolutely. So, Joe, it's time for me to turn the tables back on you. We've just launched a new monthly column looking at some of the top 10 most bought and sold shares by UK investors in the last month across 4 of the largest mainstream platforms. So, could you give us a flavour of some of the heroes and zeros we've been seeing in that list, please?
Absolutely. So, just touching briefly on the methodology, we looked at the most and least popular investments across Hargreaves Lansdown, AJ Bell, Interact Investor, and Best Invest. I'll canter through the shares very quickly, given we're focusing on investment trust news, but it does provide an interesting insight into investor sentiment, which does seem to be slightly cooling on some of the Magnificent Seven. No prizes for guessing that Nvidia topped the most bought list after its shares finally dipped on its latest results, which, in fairness, were very good, but clearly not quite good enough to meet sky high expectations from investors. And yes, I am still gutted that I decided not to buy Nvidia at Christmas, given it's up year to date by 120%. So definitely the one that looks away for me. Perhaps more surprisingly, there were 2 UK blue chips next on the list at number 2 and number 3 in terms of most bought. So we had Vodafone and L&G. They're currently offering around 10% dividend yields, which clearly has caught the eye of income seekers as the base rate starts to head down, albeit very slowly. And another UK large cap, Rolls Royce, took the more questionable honours of the most sold, although investors cashing out on the back of its successful recovery programme will have more than doubled their money over the last year.
Yeah, certainly been an interesting year for Rolls Royce. And what about some of the more popular investment trusts on that list?
Yep, so the most bought trusts in descending order were Scottish Mortgage, Greencoat UK Wind, JP Morgan Global Growth and Income, Alliance Trust, and HG Capital. Again, I'll just provide a few highlights as the full article is available on the KTI website. But let's start with one of the oldest and largest investment trusts. SMT's discount has fallen from 20% to around 10% over the last year. It's had a huge share buyback program, which I think you spoke about in our first podcast, Ryan. Once a darling of tech investors, it suffered a 40% fall in share price over the last 3 years, but it has staged somewhat of a comeback with a 16% bounce in the last year. So investors are clearly backing its growth-focused strategy, and while it does hold a fair few of the Magnificent Seven, including the ubiquitous Nvidia, it also holds other companies such as Ferrari, Moderna, and PDD. So quite a diversified portfolio there, both by sector and also by geography.
Indeed. And also nice to see HG Capital on the list as well, having mentioned that in last month's podcast.
Absolutely.
And could you just talk us through Greencoat, please? It's interesting to see that up in second place on the list.
Sure. So Greencoat is easily the largest trust in the AIC renewable energy infrastructure sector. It holds around 50 wind farms in the UK. As we know, it's been in the news very regularly, our net zero commitments will require a huge shift from fossil fuels to renewable energy. So there's a number of very strong growth drivers in that sector. As one of our colleagues said, Greencoat is likely to benefit from falling interest rates. So we think investors might be looking to lock in the chunky yield of around 7.5%. Plus, there's potential capital upside if the discount of around 10% narrows as sentiment towards yielding companies starts to improve.
And what about those other trusts that proved popular?
Sure. So JP Morgan Global Growth and Income merged with three trusts. So it's now the largest trust in the AIC global equity income sector by some margin. Given it's achieved a 5-year net asset value return of around 100%, you can see why it's earned its place in investors' portfolios. It also pays a dividend equal to 4% of year-end NAV, and that provides the flexibility for a larger allocation to growthier equities. Moving on, the newly merged Witten Alliance Trust, ATST, had the thumbs up from investors. We think they're looking for a one-stop shop for global equities. It's got a fairly unique setup. It has 10 or so managers, and they're asked to pick a 20 or so stock best ideas portfolio. And the trust will tilt manager allocations as needed, for example, towards growth or value. It's delivered a 5-year NAV return of 60% plus and also 57 consecutive years of dividend growth. So that, I think, is testament to the success of that strategy. And finally, you mentioned HG Capital. That's also caught the eye of investors. It's jogged up an impressive 5-year NAV return of 130%. In your podcast, you mentioned some of the healthy premiums to NAV on HG's exits this year, which has clearly helped to allay investor concerns about some of the valuations of private equity portfolios. And given the growing number of companies either going or staying private, it does provide investors with exposure to the private market. And on that note, that's it for this month's podcast on investment trust news. If you'd like to find out more on any of the topics we've covered today, head over to the Kepler Trust Intelligence website. And if there's anything you'd like us to cover in future podcasts, please drop me an email. Thanks to Ryan for joining us today. And on that note, we hope you join us again soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.